The world's biggest oil lifeline is burning, not just in pipelines or ports, but across the entire global system. And this time, the shock didn't stay in the oil fields. It spread, fast, from energy markets, into currencies, into bonds, and now into stock markets. This is not a localized crisis anymore. This is contagion, financial contagion, the kind that starts quietly, then accelerates beyond control. Because all it takes today is a small disruption in one critical node, a drone strike on a key facility, a sudden supply cut, a geopolitical escalation, and that single event begins to ripple outward. Oil prices spike, inflation expectations rise, central banks react, liquidity tightens, markets begin to crack. This is the chain reaction, and it's already in motion. Think about this. A relatively cheap disruption in an oil field, something that costs thousands or maybe tens of thousands, can trigger movements in markets worth trillions. That's the David versus Goliath moment. Small shock, massive consequence. And that's why this matters. Because the global financial system is no longer built for isolation. It's built on interconnection. Every market linked, every asset tied to another. Which means when one piece moves, everything else feels it. Now let's break it down. Oil is the foundation. It fuels economies, powers transportation, drives industrial output. When oil prices rise, costs rise across the entire system. Right now, oil is under pressure. Supply risks, geopolitical tensions, strategic disruptions. Prices move higher. And when prices move higher, inflation follows. This is not theoretical. We've seen it before. Higher energy costs feed directly into consumer prices. Transportation becomes more expensive. Goods become more expensive. Services follow. Inflation spreads. Now central banks step in. Because their primary objective is stability. So they raise interest rates, tighten liquidity, reduce money supply. But here's the problem. The system is already overloaded with debt. Global debt has crossed $300 trillion. Governments, corporations, individuals, all dependent on cheap borrowing. When rates rise, that borrowing becomes expensive. Debt servicing costs increase, and pressure builds. This is where the system begins to strain. Now move to the bond market. The backbone of global finance. Rising rates push bond yields higher. Bond prices fall. Volatility increases. This matters because bonds are not just investments. They are collateral, used in financial transactions, used to support liquidity. When bond markets become unstable, liquidity becomes unstable. And when liquidity becomes unstable, everything else follows. Now shift to equities. Stock markets have been driven for years by cheap money. Low rates, high liquidity. But that environment is changing. Higher rates reduce valuations. Investors become cautious. Capital flows shift. Markets begin to wobble. And when they wobble, sentiment changes. Confidence declines. This is how a crisis spreads. From oil, to inflation, to rates, to bonds, to stocks. A chain reaction. Now here's the contrast that defines this entire situation. On the surface, everything still looks functional. Markets are open, trades are happening, systems are operating. But underneath, the pressure is building. Debt is high. Liquidity is tightening. Volatility is increasing. This is not strength. This is fragility. And fragility is what leads to collapse. Now let's step back and look at history. Because this pattern is not new. In 1973, an oil shock triggered a global economic crisis. Prices surged, inflation exploded, growth slowed. That crisis didn't stay in the energy sector. It spread into financial markets, into economies, into politics. Now look at 2008. The crisis started in housing. But it didn't stay there. It spread through financial systems, through banks, through global markets. This is how modern crises work. They don't remain contained, they expand. Because the system is interconnected. Now look at today. Different trigger, same pattern. Energy disruption, financial pressure, market instability. Now let's go deeper into the hidden forces driving this. The first is leverage. The global system is built on borrowed money. Leverage amplifies gains, but also amplifies losses. When markets are stable, leverage works. But when volatility increases, leverage becomes dangerous. Because losses accelerate. The second force is liquidity dependence. Markets rely on constant liquidity, cheap money, easy access to credit. But when central banks tighten, that liquidity disappears. And when liquidity disappears, markets break. The third force is geopolitical tension. Energy markets are not just economic. They are strategic. Control over oil means control over the system. And in times of tension, that control is contested. This creates instability. Now combine all three forces: leverage, liquidity tightening, geopolitical risk, and you get a system under extreme pressure. This is not a normal correction. This is a structural stress event. Now let's look forward. In the next 24 to 72 hours, markets may react sharply to new developments. Oil price movements, central bank signals, geopolitical updates. Volatility will increase. Sudden moves, unexpected shifts. Because when systems are fragile, reactions are amplified. But the real story is not short-term movement, it's long-term trajectory. If current pressures continue, we could see a synchronized downturn across multiple markets. Oil remains volatile, inflation remains elevated, rates stay high, and that combination is toxic for financial stability because it removes the safety net. In previous crises, central banks could cut rates, inject liquidity, stabilize markets. But now, their options are limited because inflation restricts their ability to act. This is the trap, and it makes the system more vulnerable. Now consider the broader implications. A sustained crisis affects not just markets, but economies. Growth slows, unemployment rises, governments face pressure. This leads to political instability. And political instability feeds back into financial markets. This is the feedback loop. And once it starts, it's hard to stop. Now here's the most important point. The crisis is not coming from one place. It's spreading. From oil fields to financial markets. From physical disruption to systemic risk. This is what makes it dangerous. Because it is no longer isolated. It is global. And global crises have global consequences. Now here's the final warning. We are not just witnessing market volatility. We are witnessing the early stages of a cascading event. A chain reaction moving through the global system. History shows us how this ends. Systems under pressure eventually break, not always completely, but enough to force change, to reset, to redefine power. The only question is this: are we at the beginning of that cascade, or already in the middle of a crisis that is spreading faster than anyone expected?